Hey, what's up, everybody? It's me, Sarah G, with the Smack, and I am back. And today we're going to be battling the banks with Frank Trotter. Woohoo!
Ooh, this could be so much fun.
So, what is Battle Bank? Tell me about it, Frank.
Well, we've been in banking for a long time, and it was funny. We started a different bank called Everbank around the year 2000. We looked out and saw banks paying low rates, having high fees, long lines at the teller lines back when people actually went into a teller line, and very non-transparent pricing. So people couldn't figure out what they were getting. We started Everbank and did great. We sold that in 2017 to TIAA. But we came back into this, and a number of the people that were involved in that to really provide value, transparency, access, and great client service to the banking community, which we still think is pretty um, unusual today. You look at the big box banks; they're paying nothing, they're charging high fees, they're not giving good service. So it really kind of opens the door for us to come in, just like a lot of advisors find against some of the big street firms.
Let me just backtrack a little bit. So, you saw the issues way back years ago with the banking industry, and then you started Everbank.
Mm-hmm.
How exactly was Everbank different?
Well, I think there are a couple of different things. Number one, I mean, this was 8 years before the iPhone. So we have to sort of think about the context of the time. This is the year the Matrix came out, 1999. And if you remember, that was a green screen sort of technology world. But we were a direct to consumer bank. We did not have branches at everbank.com. We went direct to the national community. We focused very tightly on the self-directed investor. So people who are making mostly their own decisions, they probably have a registered investment advisor taking care of most of their money, but they're also making decisions on their own and things that they like. And we were able to bring, first of all, a high value to them. Our launch in 2000 was a 601 checking account. At the time, I think the big box banks were paying nothing and charging the fees they charge today. We offered them the ability to have foreign currency deposits. We offered them the ability to buy precious metals and ultimately became a large mortgage company as well. So there were a lot of different pieces to this puzzle. But at, at the time, there really wasn't, people were barely doing internet banking, and virtually no one was doing direct to consumer banking across the country.
Why not?
It just wasn't there yet. If you think about um, technology, people have really become comfortable with that, and they've become super comfortable in a post-COVID world. But that was 2020 to 23. Back in 99, 2000, it was funny in our call center when we have all these really folks up on Long Island. It used to be branch managers in New York and so on, so it wasn't somebody reading off a script. But the original 99 2000 response, most typical response was take off your cap locks when you're putting your password in. People were thinking in AOL terms. In January 2000 was the merger of AOL and Time Warner. It was the biggest economic news of the year. And if you think about that era, people were on the little chatbot that AOL had. They didn't have text. They didn't have Twitter. They probably had a flip phone at best, maybe even a bag phone. And so banking remotely, where you didn't walk into the building, say hello to Joe or Susie, the teller, and they respond back with "Hi, Sarah," which just wasn't being done. And so being able to strip out a lot of the expense, offer a great value, be completely transparent in terms of how we charge fees or did things was just different. And it wasn't in the market at the time. And it went very well. So we ended up doing IPO in 2012, bought a failed bank in 2010, put a lot of other things together, but then sold to the TIAA company in 2017.
So, what's the idea with Battle Bank? How is it really that different?
Well, the bank, first of all, you have to look at how different it is against what else is out there. I don't. don't know where you bank. I won't ask exactly, but it's probably with one of the big 4 or 5 banks. It, you know, there are, 6 or 7 thousand banks out there, but really 80 to 90% of the deposits are held by the usual suspects. I go in periodically every 3 to 6 months and do a quick survey on their checking accounts. Currently, the highest value paid on any of the majors' checking accounts is 0.02%. Chase actually has a $25 a month fee for any balances under 20,000. Now, there are ways you can get around that with a brokerage account and things like that. But if you have secondary services, you might lose that. But if you go online and look at their premier accounts, that's what you're seeing. So that's number one. Our core product there is a high yield cash account. It is, you want to use it as a savings account? Fantastic. You want to use it as a full service checking account? Great. And it's today, if we were open, probably pay somewhere between 4 and 4.25% annually. And that's a rocking difference. Two, we have the access to precious metals, foreign currencies, principal protected deposits. Those are things that a lot of our self-directed investors like to diversify a portion of a portfolio into. And a lot of registered investment advisors use these too, because it's a very cost-effective way to enter these markets and provide diversification. And then three, on the retirement side, certainly a lot of people do the 60-40, 70-30 portfolios with their advisor. Turn it over to the registered investment advisor. But some of our people like to do other things that are eligible, or as the IRS would put it, not ineligible, for an IRA. They want to do multifamily housing and have that income producing property. Perhaps they want to do a hard money loan. Perhaps they want to invest in private equity. If you're going to call Schwab or Fidelity or Vanguard up and say, gee, I'd like to do this private equity deal, they're going to say, well, call us when they go public and we'll be happy to put it in your account, because it's just too much hassle for them. So we'll have this entire retirement division that allows people to do things that they can do in an IRA, and as an adjunct to the rest of a diversified portfolio. And on the lending side, it's kind of interesting. We have a lot of people that have a lot of precious metals. It's kind of a hard money crowd that is attentive to battle bank. But they don't want to sell that. They think this is a long-term inflation anchor. They understand it's not an income producing investment. It's not something you're trying to get return on. It's more of a protective investment. But they want to hold on to that, but maybe they need to put a deck on the back of the house. Maybe they want to make another investment. There's very few places you can actually borrow against precious metals, which is a little quirky because it seems like one of the safest collaterals that you could possibly get. 24 hours a day, all year long, I can sell that if I need to, versus say a home equity loan. So we'll be in that business, and that's a great liquidity element for our clients. And then we've got a lot of experience in providing credit to our self-directed investors nationwide, and also to some of the clients of registered investment advisors, where they don't want to send them to Wells or to Bank of America because they have to walk by the wealth management desk, they have to walk by the brokerage desk, they have to walk by all these competitive things. So we're going to be non-conflicted. We're not doing brokerage. We're not doing wealth management. So if the RIA wants to provide their client with liquidity or have a great banking opportunity, we're happy to do that for them without trying to steal them. So kind of put all those things together. And I know one of your passions and our passions is transparency. And we are very clear that any fees we charge, we will tell you about upfront, and we'll tell you why we're charging them. Mostly it's because we get charged by somebody else. Fed wires cost us money, so we're going to charge you a little bit to make a wire, but it's not going to be those prices you see off the sheets on some of the big box banks. And on a checking account, we will have a fee of $5 below 5,000 average balance, but frankly, you make that back somewhere between $2,000 and $3,000. So you're ahead of all the big box banks immediately. So all those things put together, we think it's a great offering. And then to top it off, we actually do, despite the fact that we're national, we're online, we have some of the great individuals that you can call up on the phone. They're experienced bankers. They've probably done the transaction 10,000 times before. So you get somebody that knows what they're doing. They're not reading off a script. One of our big investors, Rick Rule, loves to say, he has a wonderful relationship with his bank up in the Northwest. He's a very large individual. They should be very happy with him. But he is a wonderful bank manager. He says she knows, just a charming person, great salesperson. But when he walks in and asks her to do something, she points to a phone that's on the desk in the lobby. It's a white phone. It says, pick that up and call. Maybe they'll be able to help you. I don't know how to do that. So all those things together, we really think we put together something that really speaks to those self-directed investors and the registered investment advisor.
Why should a financial advisor care about how much interest the client is making on their cash balances?
Well, it's a classic discussion. I know we had a little debate about it from an article that RIA Biz put together and some of our other friends. But, it's interesting. The CFO of one of the large custodians, won't use the name, a couple of years ago, or about 18 months ago at an earnings call, somebody asked him why they're only paying 45 basis points on cash. And he said, well, people aren't paying attention. Why should I pay them more? And it was like, that's one of those transparency things. I'm like, oh my God, I'm sure he did wish he never said that. At the time, the rate market was between 450 and 475. If it, I don't think you're I don't think you're losing your fiduciary capacity necessarily if you don't provide your client with an opportunity to earn the highest rate, but it's getting close. Particularly if you leave it at one of those custodians at zero interest or at 45 basis points. It's just like, would you give up, just the S&P fund, maybe minus 400 basis points? Would that be a good investment for your client? I don't think so. You probably wouldn't go into the mutual fund, ETF, or combination of those to provide them with a exposure to the broad market if they were running 400 or 500 basis points below it. But here, they're more than happy to do that with sometimes 20% of people's portfolio. And you should also, this is another touch that you can do to your clients. You don't have to be all about the investments that you're controlling. You can always say, you really ought to put some money at this place if you have it in your savings account because it's better. Isn't that a nice thing to give to your client, to earn 4% on what's probably a pretty good balance? And that buys a lot of cups of Starbucks along the way, if that's what you're into, or plane flights or nice hotels. And even the wealthiest persons appreciate that.
How does this work in terms of financial advisors investing their cash balances for their clients?
I think the way I look at it, and I have a conversation with the folks that run our personal investment portfolio from time to time. Is that a worthwhile touch twice a month for your client base to say, I've got 75 grand sitting here that's being held for something later. Why don't we put it in XYZ investment? Now, you can go to a money market mutual fund, of course. That would be responsible. You could do that at the custodian. You could put it in a bank CD. You could put it in one of the two or three, or maybe there's 10 places that you could get a higher value. But I think that's a great touch to say to your client, on average, last year, we've had 75 grand in there. Let's do it at 4% instead of 45 basis points. And, you're going to like me a little bit better. I think that's a positive touch, no different than a tax advice, or not advice, tax hint. Use the right terminology there.
Is that the right term? Right. Okay. These funny little things. Okay.
Why don't you call your accountant and ask him or her about the following, and let them do the hard work? But it's just a nice touch, and it's a value. And it's interesting if you think about transparency. The big custodians, particularly West Coast ones that have now moved to Texas, say, well, gee, this is how we're paying for things. And if you think about transparency, when they first came out with that, rates were very low. The highest earning accounts were making 60, 70 basis points. And they were paying nothing. And at that point, you say, oh, okay, I'm not going to worry too much about that because I'm not going to make too much more. Well, at 4%, that's different. So that's a hidden fee that just goes up and spreads out as that rate, the rates in the real market get larger. So when they're selling all that cash into Fed funds at 5.5 over the last year or so, that's pretty good fee to do those services at 80 basis points. Okay, I get it. That's paying for it. But at that point, maybe you leave the money at the big custodians.
How do custodians make money?
Well, as you know, there's a lot of different pieces to that, but I think a couple of one of the public ones, I think there's really only one public big one, nearly 50% of their income comes from net spread on interest. The rest of it comes from, trading fees and, mutual fund fees that they operate, registered, investment advice fees that they get. And of course, all of what best, what RIAs pay to these custodians. Sometimes it's a little hard to pick apart, but there's fees for all of that. But more and more, as they've gone to the zero trading cost model, it's from that net spread. But that net spread is variable. It's variable with the market and what they're paying on those cash balances. So again, 45 basis points payout to the client, 5.5% in Fed funds. That's a pretty sporty fee. At 0% paid to the client, 80 basis points. It's a little narrow. So it kind of fluctuates as the market changes.
But the custodian has a vested interest in you not, as the registered investment advisor, in you not moving that cash out into a 4% note.
Sure. And on the other hand, they're more than happy to take that money in a money market mutual fund. It's going to pay that much. So, it's even in-house, they're going to lose that cash balance if an advisor's acting in what my view is responsibly. The advisor should be on top of that, providing a client with a better value. And that should be a great service, whether it's at the custodian or whether it's outside.
But doesn't the higher yield come with lockup, less liquidity?
Money market mutual funds are buck funds, so they should be able to call up that morning and withdraw to as long as you're not doing a couple $100 million. And certainly savings accounts and money market accounts at banks are definitely same day transferable. We have a lot of clients at former, and we're expecting to have a lot that'll link their account at the custodian with us, no different than a transfer to a local bank or paying the utility bill. And if they want to push money there, great. If they want to pull it out, great. And I know there's also a bit of a debate on whether you charge an advisor fee on cash. But I'll leave that for a different person to answer.
That's a LinkedIn poll. Let me leave that to duke it out on LinkedIn with people. Thanks for inspiring me. I'm going to post that actually.
And it's an interesting question. I think some do and some don't. When we had the RIA at Everbank, we didn't. That's not we felt was the right thing to do. But I know some people have that debate. How about that? I'll leave it for the lawyers and the regulatory compliance officers to work that one out, duke that one out.
So what are the key takeaways you would have for registered investment advisors watching this podcast?
I think one of the key takeaways there is, there's a lot of different things out there. And I think many people focus on just building that 60-40 portfolio, taking people to dinner and making sure that they have a good client relationship. And that's great. If that's the way it works for you, more power to you. But I think, the more opportunities you show a client that are rational, that you have vetted, and are a benefit for the client, can't hurt your practice. If you can, ring somebody up and say, hey, let's make you an extra $3 or $4 grand a year, and just on stuff that we would be sitting idle otherwise, I think that's a benefit. And like everything else, we have other diversifications. We're long term have been talking about precious metals for 40 years, frankly. It just is an anchor and a diversification. And there are a couple of ETFs and mutual funds that you can participate in. They're a little sporty on the fees. And think about diversification all the time, just what else is out there, not just get lazy and say, oh, sure, I just got to build this quick portfolio after going through the risk questionnaire and the model spits something out. Here it is, Mr. and Ms. So-and-so. Do a little more work, bring a benefit. We appreciate it when our advisor rings up and says, you might want to think about this. So that's a way I would put it. not a revelation or anything, but it's something that I think a lot of people kind of forget and get lazy about.
All right, Frank, this is great. So how can people find you?
Couple places to find us. We, of course, no surprise, battlebank.com is the key place. We'd love to have you come there and join our wait list. And I think LinkedIn, of course, both my own personal, Frank Trotter, as well as our Battlebank handle, provide some information. We're going to be putting some market commentary up in the latter part of the week, and we try to do something a little more provocative at the front of the week. And so we'll keep doing that, and hope you all come in and follow us and see what's going on.
Well, it certainly is an exciting concept, battling bank opacity.
We're going to battle for better banking.
That's great. That's great. All right, Frank, thanks for being here. So everybody, please stay tuned for the next one, and thanks for listening.